My name is Jeanna Smialek. I'm the Federal Reserve and economy reporter at the New York Times, and I am here today to moderate a panel on macrofinancial stability amid high global economic uncertainty. Our panelists today are Mario Catalan, Deputy Division Chief of the Monetary and Capital Markets Department at the International Monetary Fund, Andrea Deghi, the financial sector expert at the Monetary and Capital Markets Department, and José de Gregorio, the former central bank governor and minister of economy of Chile, who is connecting with us virtually. Thank you all three for being here for what is sure to be a very interesting discussion. Mario, if we could start with you. The chapter that we are discussing today focuses on the financial stability implications of high macroeconomic uncertainty. Why did you choose this topic, and what are some of the key findings of the chapter?
Thank you, Jeanna. The main motivation is the observation that uncertainty, as measured by different indicators, has been very high in recent years relative to the pre-pandemic period. This uncertainty has been high on the back of well-known developments such as the surge of inflation, geopolitical tensions, emerging new technologies, and the realization of some climate-related risks. In the chapter, we look at three different sources of uncertainty. Uncertainty related to shocks that originate in the real sector of the economy, such as productivity, profitability of firms, prices. Uncertainty that originates in policies, fiscal, monetary, regulatory, or trade policies. And uncertainty that originates in geopolitical developments and geopolitical tensions around the world. In the chapter, we address the question of whether these different sources of uncertainty can have implications for financial stability risks. What we mean by financial stability risks is systemic risk, that is the risk that disruptions in the financial sector could have extreme negative consequences for the real economy. And operationally, we look at extreme downside tail risk for the future real GDP growth. And we performed the empirical analysis for 40 advanced and emerging market economies, covering 3 decades of data. And our analysis yields 3 main findings. First, we find that higher levels of uncertainty can exacerbate downside tail risks to future real GDP growth. Second, we find that uncertainty can generate cross-border spillovers through trade and financial channels, and countries can mitigate some of the transmission of uncertainty across borders by holding larger buffers of international reserves and by allowing more flexibility to exchange rate adjustments. And the third finding is that when you have situations where uncertainty is very high and you have an easing of financial conditions and downside tail risk becomes more extreme, more intense, macroprudential policies can help to offset some of these risks. So if you tighten macroprudential policy, you could mitigate some of this intensification of downside risks to the economy.
Okay, interesting. And Andrea, if it's the case that macroeconomic uncertainty is increasing downside risks to future growth, how exactly does that happen? What are some of the channels through which growth is impacted?
Yeah, thank you, Jeanna. So first of all, it's important to recognize that uncertainty can have both positive and negative effects in principle on the macroeconomy. So for the first, you can think about situations like early in the 90s with the rising of the World Wide Web, which was accompanied by a lot of excitement about the new technology, but it was not clear at the beginning what would have been overall the impact on the economy. So this can be considered therefore like an example of so-called good uncertainty because it led eventually to positive economic growth. Now, what we are dealing in the chapter is specifically with that form of uncertainty instead that can tilt the risk of growth to the downside, as mentioned earlier by Mario. And here we can think about 3 main channels in general. The first one that is based on the reaction of markets, which we define as the market channel. And the idea is simply that in periods of high uncertainty, investors in general can demand higher compensations because of the additional risk due to uncertain macroeconomic outcomes. So this can lead, for example, to an increase in the risk premia, lower stock prices, and also higher borrowing costs. If then this is associated, for example, with additional financial constraints in the economy, what can happen is that it can lead, for example, to a slowdown of the economy, and also to potentially spikes in volatility in the markets that can increase what we call market risk, as before, which we define as the risk of sudden and large market price correction. The second mechanism is through banks. So it's the credit channels, and the idea here is that uncertainty can make, for example, banks to become, for them, more difficult to assess what is the credit worthiness of new borrowers, especially when there is a lack of clear information. So if this then comes together also with a higher risk, for example, on their portfolio positions, it can happen that they can decide, for example, to hoard liquidity to hedge, for example, against the possibility of future adverse shocks, but also to curtail the lending to the economy. The last channel are about the direct effects instead that uncertainty can have on the real economy. And here is the idea that uncertainty can, for example, delay certain decisions, for example, for corporates and households, because of the increased value of waiting during periods of high uncertainty. So practically speaking, this means, for example, that corporates might delay their investment as well as hiring, which can then in turn lead, of course, to slower economic growth. Now, so we've seen that there are three channels. So there is the market, the credit, and the real channel. Of course, these do not operate in isolations, but what we see is that often they can interact and reinforce each other in such a way that they can amplify some adverse shocks that, for example, arise in certain parts of the financial system, but can lead them to have also broader implications for the world economy. And this is a particularly important thing that factor that we highlight in our chapter, because we see that indeed the macroeconomic uncertainty has also stronger impact when there are pre-existing macrofinancial vulnerabilities. So think about the case of a country with high sovereign debt. Amid a very uncertain macroeconomic outlook, it could be possible that, for example, an expansionary fiscal shock might lead to strong reactions in investors that can increase sell-off and lead eventually to higher sovereign bond yields. Same thing could happen in principle, so of course, in the corporate sector. And those are all important considerations, because what we see right now in the conjuncture is that both macroeconomic uncertainty and macrofinancial vulnerabilities are elevated right now.
Okay, interesting. And Jose, I wonder if you could talk a little bit about what your views are about the role of macroeconomic uncertainty when it comes to financial stability. Is there a threat here?
Yeah, before I think that it's important to put in perspective the chapter, which is very interesting. I think that I like it a lot reading. We learn a lot. But I would like to make two previous points on the discussion. First, some comments on the current state of macro, financial system, and policy making in the world, in particular in emerging markets. And I think that this is a good way to frame also the discussion, because I think that we have had great macro policies in the last 20 years. We had the global financial crisis that was like the Great Depression in terms of shocks, but with a minimal impact compared to the Great Depression. We have COVID, and amazing, and pandemic, and after a year, there was a very moderate output decline, about 3 to 4% around the world, for an economy that was for a world that was locked down 3, 4, 5, 6 months somewhere. So I think that the performance in emerging markets has been much better than from the last crisis. That was the Asian crisis. The Asian crisis was tiny compared to the 97, compared to what came after that. But the tiny magnitude with a huge cost, and so I think that that we have to recognize that it's a much safer world, much better policy making. Inflation increased in 2021. Now it's declining. Central bank have done what we said for many, many years that they should do, have inflation targets, being independent, and they increase rates and inflation coming down, and financial system are strong enough that we didn't have one of the concerns that many times have, that increasing interest rate could cause some form of vulnerability. More recently, we have wars. We have a stock market crash without the need of taking a special actions. You may say, why all this preamble? And I think that because before proposing policies, and I think that we have to know what has gone right. And because the world has, in my view, much better monetary and financial policies, strong financial systems, and good fiscal policy. This does not rule out that we will have problems, as the effects of uncertainty can create problems. But we can predict that we know how to handle them. So from a policy making point of view, of course, we have to be cautious and say, well, although things are strong, we need to be sure and to put some reinforcement to the macroeconomic infrastructure so we do well, and that's part of the discussion in this chapter. And the second thing that I would like to talk before going into the details, I think that is that this chapter makes us a lot to think about uncertainty. What is uncertainty? Where comes uncertainty? And what does it say about the future? Because if I have the claim that the world is safer, why indicators of uncertainty have increased? And I think that this is perfectly consistent. The indicators, which are not necessarily the financial, I like a lot the focus on indicators based on activity, are signaling that people feel that in the future many things may happen. We could have in the future a pandemic, something that perhaps 10 years ago we were not thinking. We may have inflation. We already had inflation, so people say we have wars, okay? But that does imply that the increased uncertainty means that people is more afraid about what's going on. I don't think that that's necessarily the case. There could be a pandemic with a recession, but not a collapse. There could be inflation, and it will have cost. Inflation has cost. Reducing inflation has cost, but that may have may result in a softer adjustment than before. This is not the reduction of inflation of the 1980s in the US. It's much more moderate, the output cost. So we have to control it. So I said there is a lot of uncertainty because many things may happen, and that may have impact. And as this chapter emphasized, the shocks have different impacts according to the levels of uncertainty. But do this uncertainty means that people is afraid, which is another way to put it more or that outcomes could be very bad. And so are the estimations based with past data a good estimation of what people really feels that will happen? So this is a thing that I don't know how to do it and to solve it empirically, but I think that is quite an important point when we talk about uncertainty. And this chapter, I think that does a very good job in showing how uncertainty affects the impact of different shocks on activity and financial stability. And one thing that is quite important, we have to commend the chapter, is that there is that the effects are asymmetric. And I think that that's also quite important in terms of learning and trying to think what we do for the future.
That's interesting. And Mario, the chapter also highlights that the high level of macroeconomic uncertainty has not really been reflected in financial market indicators such as stock market volatility. I wonder if you could kind of walk us through what we should make of that macro market disconnect. Should we be concerned about this? What does it imply for risks? How should we think about this issue?
Yes, this is the second main observation in the chapter, that uncertainty is high, but on the other hand, when we see financial market indicators, for example, implied or realized volatility in stock markets, there has been a disconnect, which we call macro market disconnect. And this is not the first time it happens, so there are moments where we observe these situations where uncertainty is high and is not fully reflected in financial market volatility. And there are some explanations, some reasons in the academic literature that have tried to study why this happens. So one of them, for example, that you can think about is the possibility of central bank puts limiting spikes in volatility. So if market participants have the perception that the central banks will actually intervene, this may limit volatility in the markets and create a disconnect with fundamental uncertainty, which could be high. So in the chapter, what we do is to show that when you have these disconnects between the market and these alternative measures of uncertainty, this has implications for tail risks to the economy. So it exacerbates the downside risks to future GDP growth. And some of the mechanisms have already been mentioned by Andrea, but loose financial conditions tend to generate vulnerabilities in the form of accumulation of debt. Given that volatility is far away from the uncertainty, we have the concern that this volatility could at some point spike in order to close the gap, and this may lead to a sudden repricing of financial assets that could turn out to be disorderly, and this in turn can generate disruptions and a negative outcome for the overall economy. So that's why we believe this result is important. And in addition, one of the contributions of the chapter is to show that uncertainty can add valuable information when you try to predict these extreme events. So the typical systemic risk assessment frameworks look at financial conditions or conditions in the banking system and how this determines these downside tail risks. Here we show that if you also consider these macroeconomic uncertainty measures, you can improve the predictions of systemic risk.
Okay, interesting. And Andrea, I wonder if you can talk us through, and I'm sure Jose will also have thoughts on this, but I wonder if you can start, what can policymakers do to address the risks from macroeconomic uncertainty that you all are identifying here?
Yeah, thank you for this question. So what we report in the chapter are mainly two different type of policy actions. So one is to reduce macroeconomic uncertainty, and the other one instead is to mitigate what are the potential adverse effects that this might have in the future on future economic activity. On the first, relatively how basically to reduce macroeconomic uncertainty, we focus mostly on efforts to enhance basically policy framework. And these in particular countries should take some steps, for example, to enforce monetary and fiscal rules. And this is important because also in relation to what also José was mentioning before, when we look at the financial sector, this is in constant evolution. So there are constant innovations, for example, due to technological breakthroughs, which could have also the impact of creating or introducing some regulatory loopholes and introducing also new complications that can in turn lead to higher financial stability risk. So from a policy perspective, what we say that is important is that regulatory response should be timely, but also mindful of the possibility that certain type of actions might increase economic policy uncertainty in certain market agents, leading this to this potential increase in tail risk that we discussed before. In this context, having also credible, for example, policy frameworks is helpful also for because it has two main advantages. First, it allows for having more policy space in the case of some extreme events that might materialize, but also because in principle, and there is some empirical literature showing on this, they can help to increase or to enhance monetary policy pass-through that could be impaired during periods of high uncertainty through the different mechanisms that I was just mentioning before. When we move then at the measures that instead can policymakers can take in order to mitigate what are the potential losses due to an increase of macroeconomic uncertainty. First, countries should seek, for example, to maintain the sovereign debt level at a sustainable level, because this is especially important, for example, for emerging markets, as was mentioned before by José, because these tend to be subject to sudden, for example, shifts in capital flows, especially when there is an increase in global uncertainty. So beyond fiscal measures, what we also show is that the macroprudential policy measures can make a difference. In particular, we have results that shows that these can impact what we call this intertemporal trade-off of financial conditions that also Mario touched upon. And the idea there is quite simple, is that following an easing of financial conditions, for example, through lower interest rates, helps basically to boost the slowing economy, but it can also at the same time lead to higher risk-taking that can then generate the build-up of certain type of vulnerabilities and therefore increase the probability of some economic costs then down the road. Through our analysis, what we actually show is that macroprudential measures, think about, for example, limits about borrowers' eligibility, loans constraints, or some requirements about capital buffers for banks, can actually help to tame this build-up of vulnerability, which can in turn, of course, help to reduce the downside risk in the medium term and help basically policy to deal with this challenging trade-off. Finally, what we mention also among these measures, so Mario was mentioning before that macroeconomic uncertainty does not have only an impact on the domestic country, but they can also have potential spillover effects. So among our recommendations, what we also highlight is that countries should ensure that there is an adequate safety net in place in order to mitigate these potential spillover effects. Some examples that we mention are, for example, the build-up of international reserve buffers, or allowing, for example, also for a more flexible exchange rates that could help to mitigate, for instance, the potential adverse effect of rising geopolitical risk that could affect, of course, through different channels, the global economy.
Okay, interesting. And Jose, I wonder, obviously you've got some more real world experience on this one. I wonder if you can talk through what Andrea just said and, maybe respond with what challenges you think policymakers might face in sort of mitigating this uncertainty and dealing with the risks around it.
Yeah, this is a very important question, I think. And first of all, I think that Mario made a very important point, and which is this discussion, why there is some sort of the linking between volatility in financial markets and volatility in the real economy. So sometimes we have events that are quite volatile, war, things like that, but they don't go to financial systems because people trust that the central bank has the tools and the ability to solve the problem, and all the rest of authorities. So I think that's quite important to bear in mind. So, and this leads me to the first thing that policymakers must do face of this. They have to make sure that they understand what's going on, what are the instruments that they have at their disposal, and act accordingly. I think that sometimes, and this was much more common in the past, too much activism may signal insecure policymakers, or that they don't know exactly what they are doing, so they deploy a lot of instruments and very active because they don't know how to handle them. So, because at the end, credibility is not only an issue about policies, also there is credibility about the quality of policymakers. So I think that this is today, there may be a lot of uncertainty about the future, but confidence that policymakers will do whatever it takes, and they know what is needed to save the economy. So what are the things, and I think that's important, that was just mentioned, what are the things that you have to have in mind? First is strong financial regulation. So we cannot, and one thing that we know that makes a recession bad or very bad is when the recession comes with some form of financial instability and the bankruptcy of the bank or some form of financial crisis. Recessions are much worse, and Latin America, many regions are very. It was very common in the past, an exchange rate crisis, which would say, well, there will be an adjustment, but the exchange rate adjustment led to a financial crisis, and that made the crisis much worse than if you would have had a strong financial system. And I think that this has been learned. The financial systems in the last 20 years have been quite resilient in emerging markets. So this, I think that's quite important. And as mentioned, a policy of inflation targeting with an independent central bank that also have flexibility in the exchange rate to avoid misalignments, and they are very costly from the financial system, and that also can guide the adjustment through price signals, the exchange rate. I think that's very important. A strong fiscal is always necessary, because if there is a crisis and at the end you need to put money on the crisis, the money must come from the budget. It cannot be created by the central bank or some other form. So you need a strong fiscal position. Now, there is an issue that I think that it's important to think more about it and has been discussed in the chapter, and is how to move prudential policies. So how to make them macroprudential and move them. The chapter emphasizes that in times of loose financial conditions, downside risk on output could be exacerbated. Now, but let's think what's going on right now in the world. Inflation has been controlled with tight monetary policy. It's time to loosen. And most countries are loosening monetary policy. Now the question is, while they are loosening, they should apply some tightening from the macroprudential side in order to avoid vulnerabilities. But the tightening of the macroprudential goes against the monetary loosening in terms of financial conditions. So I think that we have to be very careful on the timing and on the complementarity between adjusting prudential policies on a more cyclical way and what do we do from the side of monetary policy.
Okay, interesting. And I think we are nearing our end here, but I wonder either Mario or Andrea, whoever has time, whoever wants to take it, I wonder if you could speak a little bit to what the role of the IMF is here. What can the fund do to assist its member countries to deal with the sort of levels of high uncertainty that we've been seeing?
So thank you for the question. So first, let me say that we fully agree with José on his point about the improved policy making in the emerging market countries. We have seen some of the rewards of these improved policy frameworks recently and also during the global financial crisis. So even at an early stage, we saw that. In terms of the IMF tries to help different countries through different activities. So through its surveillance activities, bilaterally, it engages with countries through the Article 4 consultations. And in that role, the IMF provides advice on how to improve policy frameworks, how to avoid very large imbalances that could exacerbate the risks of crisis. So this is a constant work that the IMF is doing bilaterally with countries. The IMF also provides capacity development and technical assistance to countries so they can have the capacity to develop the frameworks by themselves and also learn from the international experience. So the IMF, to some extent, learns from some countries and helps other countries incorporate this knowledge through technical assistance. And then we also have the multilateral surveillance vehicles, such as the Global Financial Stability Report, where sometimes we developed, in the analytical chapters, we developed tools that can be used to improve systemic risk monitoring. And these tools are used either by country teams in the context of Article 4, or sometimes central banks adopt these tools and tailor them to the specific country conditions to improve the systemic risk assessment framework. So that's another contribution that the IMF makes to try to help countries reduce policy uncertainty, improve policy making in general.
Okay, great.
I can maybe
think
slightly add maybe just one quick point. First, I want just to echo very briefly also before the points of José and Mario, that it's important, of course, when thinking about the macro-potential measure, especially at that kind of conjuncture. This should be carefully calibrated, especially in terms of how they should be targeted, what is the intensity, as well as the right time. And they should be targeted in such a way to reflect the country-specific macro-financial conditions, as well as the pre-existing vulnerabilities. I then wanted to add briefly just another quick point about the importance also improving systemic risk frameworks because of the emergence of these new risks that can also explain partially the presence of this disconnect that we've been talking about during the discussion. And one of the factors that indeed we try to highlight, or this one of the results that we highlight in our analysis, is the importance of considering macroeconomic uncertainty measures beyond some of the measures that are usually used in our systemic risk framework, like the VIX or other volatility indicators. And this we see through our analysis, it can be important to make, for example, better prediction, better scenario analysis that can be relevant for stress testing, but also to provide, for example, additional information that could be about the state of the economy that could be relevant for policy making. And here, there is indeed an important point that also we try to highlight, is that this result is particularly true also when we try to augment our current systemic risk models with machine learning and AI tools. So indeed, this we see that can have two benefits. One is that they can improve effectively the predictions of some of tail risk, but also, for example, through large language models, allows us basically to extract the information from alternative data sources like text-based documents, which in principle can also allow us to more efficient real-time assessment of systemic risk. So looking forward, we are trying to build up on these efforts from the chapter and make it part more structurally to our systemic risk framework. At the same time, we also hope that this will incentivize other central bank policy institutions to both consider macroeconomic uncertainty measures and the AI tools, of course, with the due caveats that they come with these sophisticated models, in order to enhance the predictions of tail risk as well as the overall systemic risk framework.
Okay, wonderful. I think that is everything we had to go over. Thank you all three of you so much for joining the panel today. It's been a really interesting discussion.
Thank you, Jeanna.